Preparing profit and loss statements. Calculating profit and loss. There are two methods of organizing a profit and loss account: single entry or double entry. In the single entry method, the revenue and expenses are listed in one column. In the more common double entry method, revenue and expenses are separated into their own columns. Examples are provided on the following slides. Here we have an example of the single entry method framework. We have sales and receipts, closing valuations, less expenses, opening valuation, expenses, total expenses, net profit, grand total if we scroll down. Notice the clearly marked business name, date of accounting, and account type. In this example, we have the LE acronym being used and the currency being used as well. Calculating profit and loss. The opening and closing valuation amounts are from the farm valuation account. Since a profit and loss account is a summary, the individual sales do not need to be identified. They are recorded on other types of accounts. However, the total amount for each type of sale should be recognized. For the total receipts, add the amounts from each of the sales and receipts. It's a good idea to include a line at the top of the total and an LE before the total, since the numbers may change when money owed is paid. The total receipts are also known as net sales or net revenue. If you would like to denote these identifiers, do so below the total receipts as shown below. These titles are helpful when calculating profit margins and analyzing enterprises. Again, the opening and closing valuation amounts are from the farm valuation account. Since the P&L account is a summary, individual expenses do not need to be identified. The total amount for each type of expense should be recognized. For the total expenses, add the amounts from each of the expenses. It's a good idea to include a line at the top of the total and an LE before the total, since the numbers may change when all monies are paid. The total expenses are also known as cost of revenue or cost of goods sold. If you would like to denote these identifiers, do so below the total expenses as shown below. These titles are helpful when calculating cost margins and analyzing enterprises. Subtract expenses from sales to determine the net profit. The grand total is the sum of expenses and profit. It demonstrates how much money moved into and out of the business. The total revenue and grand total should be equivalent. With the double entry profit and loss account statement, the details for credit, the revenue, and debit, the expenses, are placed in two different columns. Notice that the type of statement, farm name, and date as with the single entry method. Instead of two sections in a row, the expenses and revenue are split into two columns. As with the single entry, the currency and latest estimate acronym should be included. Total indicates the sum of the various numbers in each column. Net profit is determined by subtracting expenses from revenue. Grand total is the sum of profit and expenses. Using the template below and amounts from the single entry method, also copied on the following slide, can you complete this profit and loss statement? Try it out. Use the information from Ogun State Farm's accounts for the period ending 31/12/22 to create your P&L statement. All numbers are latest estimates in Naira. Don't forget to total the numbers as needed. A possible example is on the following slide. Here's the example. How does your P&L statement compare? The profit and loss statement primarily focuses on the company's revenues and expenses during a particular period. It provides valuable insights into a company's operations, the efficiency of its management, underperforming sectors, and its performance relative to peers. As previously discussed, the key items included on the profit and loss statement include the following: revenue, money generated from normal business operations such as sale of crops; cost of goods sold, direct costs of producing the goods sold by a company, including the cost of materials, fertilizer, seed, etc., and labor directly used to create the good; gross profit, revenue less cost of goods sold; net profit, sales minus cost of goods sold, selling, general and administrative expenses, operating expenses, depreciation, interest, taxes, and other expenses, indicator of a company's profitability. Notice the clearly marked business name, date of accounting, and account type.